Hey there, fellow investors, let's talk about making money in the market. Sometimes the simplest strategies are the most powerful. Today I want to break down dollar cost averaging, or DCA. DCA is like the tortoise in the race against the hare. Slow and steady, it's a proven winner over the long haul. DCA takes the emotion out of investing. Whether you're just starting out or a seasoned pro, DCA can be your secret weapon. Remember, slow and steady often wins the race. Let's get started. Dollar cost averaging is a fancy way of saying invest consistently over time. It's about taking a set amount of money and investing it at regular intervals, regardless of what the market is doing. That's right, rain or shine, bull or bear market, you stick to your plan. Here's the basic idea. Instead of trying to time the market and invest a lump sum all at once, you break up your investment into smaller chunks. You might invest monthly, bi-weekly, or whatever works best for you. The key is regularity. Think of it like setting up an automatic savings plan for your investments. By investing consistently, you'll buy more shares when prices are low and fewer shares when prices are high. Over time, this strategy can help you average out the ups and downs of the market and potentially reduce your overall risk. In the next section, we'll dive into a real-world example to see how DCA works in action. Let's say you want to invest $1,000 in a particular stock. Instead of investing it all at once, you use dollar cost averaging. You break it down into 4 equal investments of $250 each month. Month 1, the stock price is $25, you buy 10 shares. Month 2, the stock price drops to $20, you buy 12.5 shares. Month 3, the stock price climbs to $30, you buy 8.33 shares. Month 4, the stock price falls back down to $25. You buy 10 shares. After 4 months, you've purchased a total of 40.83 shares. DCA helped you acquire more shares at a lower average cost per share. Here's the thing about the stock market. It's impossible to predict with certainty what's going to happen next. Even the experts get it wrong sometimes. Timing the market perfectly, buying low and selling high is incredibly difficult. That's where DCA shines. It takes the pressure off trying to time the market perfectly. Instead of stressing about when to buy or sell, you simply stick to your regular investment schedule. Remember, time in the market is more important than timing the market. By investing consistently, you take advantage of market dips without having to predict when they'll occur. When prices are down, your fixed investment amount buys you more shares. This can help lower your average cost per share over time, a concept known as averaging down. Consistency is key in investing. DCA helps you stay disciplined and avoid making emotional decisions based on short-term market swings. This can lead to better long-term outcomes for your portfolio. Section 5. Weathering the storm DCA in bull and bear markets. You might be wondering, how does DCA perform in different market conditions? The good news is that DCA can be effective in both bull markets, when prices are rising, and bear markets, when prices are falling. In a bull market, when prices are steadily climbing, DCA might seem like it's slowing you down. You might feel like you're missing out on potential gains by not investing everything up front. However, remember that markets don't go up in a straight line. By investing gradually, you're still participating in the upward trend while mitigating the risk of investing a lump sum right before a potential market correction. In a bear market, when prices are falling, DCA really proves its worth. By investing consistently during a downturn, you're buying shares at lower prices, which can significantly lower your average cost per share. This sets you up for a stronger rebound when the market eventually recovers. The key takeaway is that DCA helps you stay the course regardless of market conditions. It's a strategy designed for the long haul, not for short-term speculation. Section 6. Your emotions and your money. The psychological benefits of DCA. Investing isn't just about numbers, it's also about psychology. Our emotions can often lead us to make irrational decisions, especially when it comes to money. Fear and greed are powerful forces that can wreak havoc on our portfolios. One of the biggest advantages of DCA is that it helps remove emotion from the equation. When you have a set investment plan and stick to it regardless of market fluctuations, you're less likely to make impulsive decisions based on fear or greed. Think about it. When the market takes a sudden dive, it's easy to panic and sell everything, locking in losses. Conversely, when the market is soaring, it's tempting to go all in, only to potentially buy at the peak. DCA helps you stay disciplined and avoid these emotional pitfalls. It allows you to tune out the noise and focus on the long-term plan. This can lead to better investment outcomes and a more peaceful investing experience overall. Section 7. Where can you use DCA? The beauty of dollar-cost averaging is its versatility. You can use this strategy with a wide range of investments, including stocks. DCA is a great way to invest in individual stocks, especially if you're nervous about market volatility. Exchange-traded funds, ETFs. ETFs offer instant diversification, and DCA can be an excellent strategy for building a diversified portfolio over time. Mutual funds. Many mutual funds allow for regular investments, making them suitable for DCA. Cryptocurrency. While crypto is known for its volatility, DCA can be a strategic way to enter this emerging asset class. Essentially, if you can invest in it regularly, you can apply DCA. The key is to choose investments that align with your financial goals, risk tolerance, and time horizon. Remember, diversification is key to a well-rounded portfolio. Don't put all your eggs in one basket, no matter how promising it may seem. Section 8. Time, your greatest ally in the market. In the world of investing, time is your greatest ally. The longer you're invested, the more time your money has to potentially grow. This is especially true when you combine time with the power of compounding. Compounding is like magic. It's the concept of earning returns on your returns. As your investments generate earnings, those earnings are reinvested, and they, in turn, generate more earnings. It's a snowball effect that can lead to exponential growth over time. Dollar-cost averaging and long-term investing go hand in hand. By consistently investing over a long period, you give compounding more time to work its magic. The earlier you start, the more time your money has to potentially grow. Even small, regular investments can add up to significant wealth over the long term, thanks to the power of compounding. Remember, the key is to start early and stay consistent. Section 9. Dollar-cost averaging and compounding, a powerful combination. Let's take a closer look at how dollar-cost averaging and compounding can work together to boost your investment returns. Imagine you start investing $200 per month at age 25. Assuming an average annual return of 7%, here's what your investment could grow to by the time you reach age 65. Total invested, $96,000. Estimated balance at age 65, $532,540. Now let's say you wait until you're 35 to start investing the same $200 per month. Here's how the numbers change. Total invested, $72,000. Estimated balance at age 65, $244,634. As you can see, even though you invested less overall by starting at age 35, your potential returns are significantly lower. This highlights the importance of starting early and letting compounding work its magic over time. Remember, these are just estimates. Actual returns will vary based on market conditions and other factors. However, the principle remains the same. Dollar-cost averaging combined with long-term investing and compounding can be a powerful wealth-building strategy. Section 10. Potential drawbacks of dollar-cost averaging. While dollar-cost averaging is a powerful strategy, it's important to be aware of its potential drawbacks. In the spirit of transparency, let's address a couple of considerations. Potential for lower returns. In rapidly rising markets, dollar-cost averaging might lead to lower returns compared to investing a lump sum up front. This is because you're spreading out your investments over time, potentially missing out on some initial gains. Fees. If you're using a brokerage account or mutual fund that charges transaction fees, dollar-cost averaging could result in higher fees over time due to the frequent transactions. It's crucial to weigh these factors against the benefits of dollar-cost averaging, such as reduced risk and emotional investing. For many investors, the peace of mind and consistency offered by dollar-cost averaging outweigh these potential drawbacks. Remember, the best investment strategy is the one that aligns with your individual circumstances, risk tolerance, and financial goals. Section 11. Conclusion. Start your dollar-cost averaging journey today. Dollar-cost averaging is a powerful tool for investors of all levels. It takes the guesswork out of timing the market, helps you stay disciplined, and can potentially boost your returns over the long haul. Remember these key takeaways. Consistency is key. Invest regularly, regardless of market ups and downs. Time is your friend. The earlier you start, the more time your money has to grow. Emotions are the enemy. Dollar cost averaging helps you avoid making impulsive investment decisions. If you're ready to start building wealth steadily and confidently, consider incorporating dollar cost averaging into your investment strategy. Remember, slow and steady often wins the race when it comes to investing. Start small, stay consistent, and watch your investments grow over time. Happy investing!